First of all, thank you so much for taking the interview for our Rent Magazine piece. And we want to start with just a brief introduction. So if you can just tell me a little bit about yourself, Betty, and about K Properties, we can start there.
Oh, that sounds great. So I've been in real estate forever, it seems, but since the 80s. And so I've seen a lot happening in the market, a lot going on, a lot of changes, a lot of ups and downs. My background started in residential and then actually ski resort, new home sales before I opened my own commercial real estate firm in Winchester, Virginia. So it was a good run. After that, I wasn't really happy being an owner. So I moved into triple net sales, and that was really an exciting avenue for me. It's an interesting one for apartment owners because many of my investors were actually apartment owners because they were tired of the management of the whole thing. So they would get out of apartments and into triple net properties. But as I did that, I kept seeing people putting so much of their net worth into one building, and that one building might be something like a Wendy's, and it might be a franchisee. And I'm thinking, oh, $4 million or $3.5 million and $2 million on a loan just made me stop and think. And I often said it that, oh, that seems like a lot of money in one building. So when I found the DSTs, it was a really easy transition to say, I didn't want the management anymore of the apartments. And so now I get to have management taking care of me, and I'm in a DST world. And so I'll tell you how DST works later, but the K Properties was a really natural fit for me because the emphasis here is on education. And that's what's so important to our investors, is just making sure that people understand what they're doing, and they understand the market, they understand the DST, the 1031 exchange. And it really is something that Dwight K just harps on all the time. Client comes first and education is king. So he's been in business since the 2010, I guess, is when, or at least when K Properties started. And we really are a company that's probably the most experienced, the most knowledgeable, the most education focused company in the industry. We really do focus on DSTs and 1031 exchanges, and we don't do things like stocks and bonds and puts and calls and annuities and all the other things that a financial planner would do for you. We do this because we're real estate people. We only work with the DST, which is real estate wrapped in a securities wrapper. So K Properties itself, I would say we are probably the largest, or one of the largest 1031 exchange properties. We placed, I guess it was a record of over $600 million last year in equity.
Oh, wow.
Yeah. So
That's
there was,
incredible.
yeah, a lot going on. And we've participated in over 30 billion in syndicated offerings now. So it's something we live and breathe and do every day. So a good platform for me to move from regular triple net sales into offering a piece of a property instead of the whole thing.
Yeah, let's talk about that a little bit more because, you mentioned DSTs, Delaware Statutory Trusts. Just in case someone listening to this doesn't know what those are, I'm sure you could give a really good explanation since you live and breathe it every day.
I do indeed. So yeah, it rolled kind of nicely into that because the DST is really where you would own a piece or a slice of a pie. So you would own a piece of a larger institutional quality property. And that property might be something like medical or industrial or distribution, could be multifamily. So you might be going from owning 10 or 12 rentals or 2 or 3 apartment complexes, and you move into, or you stay into multifamily because you already know about that, but you're owning properties that are 300 and 400 units, and you don't have to manage it yourself. It's actually, you own a piece of that larger institutional quality property and it gets managed for you. So that basically gives investors more time to do things that we like to start doing at some point in our life, which is travel or hobbies or just relaxing instead of always worrying about that call that might come in where someone's, the little things like refrigerators breaking or something like that are not the big problems. It's when someone maybe gets hurt or something like that, where the property manager, if you have one, they don't call you about the refrigerators or sending an electrician over, but they do call you if somebody hurts themselves or falls off a balcony or a dog bites. And so those are the things that me personally, I don't want to do anymore. And again, when I saw the DSTs, I thought this is a really good way for me to get out of active management of my properties and into something that someone's taking care of it for me.
Yeah, absolutely. Even if you run your properties as smoothly as possible, there's always liability. And DSTs are absolutely a great exit strategy out of that. Obviously they've been around for a bit now, but it is increasing in popularity. You said you had the most, big year at K Properties last year. Why is that? Like, why are people interested in DSTs now more than ever?
We still have that 1031 exchange, and probably most people are familiar with the 1031 exchange. It has been around for 100 years and almost got gone at the last time the tax laws were changed a bit. There was a lot of pressure to maybe either get rid of it or put some caps on it, and nothing happened there. So that's a good thing. And we think, at least talking to the people that I know who are on the Hill a lot. I live out here in Virginia, so operate the K Properties Washington D.C. office. So we talk a lot about what's going on with the legislature. So they're not thinking that it's going to come up again for a little while, but one never knows. But that 1031 exchange really gives investors the opportunity to sell a property and buy another property without having to pay taxes on that gain. So it's a way to keep real estate in the family and pass on generational wealth, because if you do a 1031 exchange, what happens is you sell your property that you held for business or investment, and you buy another property that you held for business or investment. And so you can kick that tax can down the road. We call it swap till you drop, because it means you're going to do a 1031 exchange, another one and another one, until your heirs inherit the property. And as long as the laws don't change, they inherit it at a stepped up basis. So they won't be having taxes to pay at that point either. So those taxes effectively just disappear if you continue to do the 1031 exchange until the heirs get it. So that brings it back to the DST. They were approved back in 2004 as a like kind property for the 1031 exchange. And we have a DST 101 class every Wednesday if anybody wants to listen in on our website, kpi1031.com. So it's a very interesting way to break down the little rules that go with the 1031 exchange. But DSTs are a very popular option to not have to go out and buy your own property.
Yeah, absolutely. And I think there are also some trends that I know you've pointed out as well in previous conversations that are driving a lot of DST investments. So instead of, just switching to another property, looking at DSTs instead might be a good alternative right now. So if you could talk a little bit more on those trends, I think that might help some people decide who might be on the fence.
Yeah, well, a lot of it's just regular market. And we watch the markets. It's been 6 months now, and we're watching different indexes and different economists watching what the Fed's doing right now. There's a lot going on in the world and a lot going on in the real estate market. Some of my qualified intermediaries, that's who holds the funds when you do a 1031 exchange, some of them are saying that they're seeing that we're at a tipping point where it used to be multiple offers on every property that came out. And now I don't think we're seeing it quite as strong. So we're seeing a little bit that the inventory is starting to creep back up a bit. So it might be easier to buy a whole property right now. It's been almost impossible to try to get whole properties if that's what you're trying to do. I know that there's that old Chinese saying that says something about may we live in interesting times. And I keep thinking, can't we just go back to some boring times and just leave it, let things be settled and straight. But with the market in this flux right now, it's sometimes hard to know, do you want to buy another rental property? It certainly may not be a good time to be a flipper where you're buying something and trying to flip it for more money later, because we might be at a situation where the market is stopped trending up and is maybe now a little bit flatter. From my years in commercial real estate sales, we usually saw the commercial real estate market lagged behind the residential market a little bit. So if the residential is starting to not slow down too much, there's certainly huge volume going on right now. We're not really seeing that, and we're not really seeing prices decline much yet. But typically the commercial industry will lag behind a year or two on properties that are selling, and that would include the bigger apartment complexes too. So whether it's a Dollar General or a CVS or an apartment complex, typically those are going to stay strong for a little bit longer. Again, nobody has a crystal ball. I sometimes ask this. So I do have answers.
Well, I mean, the other thing that I've been reading a lot about is this baby boomer generation. I know that's definitely a factor in the real estate market. It's hard not to address these trends without addressing baby boomers. Or any insights there on that?
Yeah, it really is interesting being a baby boomer. I have the right to speak to this question. And what we're finding is people are indeed doing what I'm doing. I'm kind of over managing my own properties now, or even managing the managers now. I like the DST as an option for myself. And so I certainly can offer it and see if it's a good fit for somebody else. But a lot of us are looking to get out of active management, really just not having that, you said it, the liability or the responsibility of it. And the DST really gives you that freedom, because you get to look at the monthly rent checks that kind of come into your account, and you get to follow the quarterly reports to see what's happening with the properties. The year-end paperwork is just done for you, meaning you take that information from the sponsor company. That's the company that buys the property before I can offer you a piece of it. And they give it to you so that you just kind of plug it into your Schedule E. So most investors would be familiar with the Schedule E, where you fill in the gross and then the expenses and then the net. So all that's done for you. And again, it can be a situation where you're getting some diversification too, getting out of one asset class or one geographical area or one tenant, depending on what type of property you have. And then we even encourage you to look at the different companies that put together these DSTs, so you don't have all your investments into one company. So it's spread out among the different companies. But another thing, I don't know that we really thought about talking about this, but when you talked about the boomers, I'll go a little further. A lot of us are actually selling businesses or getting rid of collections that we might have, whether it's vintage cars or art or any kind of collectible, or maybe there were some stock market gains that got harvested before the stock market started going kind of in a little bit of a flux. And there's another vehicle called a qualified opportunity zone, where you can take a short or a long-term gain from any kind of capital gain. So it could be real estate, it could be the sale of a business, could be the collectibles or whatever. And you put that into a real estate development, and you're able to, again, defer and then eliminate some capital gains taxes. Just a great opportunity for some people. And some people will do a mix of the two. Put some of the money in a DST, some in a qualified opportunity zone. The opportunity zone allows you to pull out your basis. So it's an interesting concept. And again, we can go over that with you more if you get in touch with your K Properties rep.
Yeah, absolutely. And I think also too, as far as I understand, K Properties has so many different DST options. You
Mhm.
mentioned like not having to put, everything, your eggs all in one basket, so to speak.
Mhm.
So that's really helpful to have options if you did want to try out different types of real estate and opportunity zones as well. So that's really important. And I think also we can't underestimate the value of time. And I think even as young as I am, I still I still
Mhm.
also value my time a lot. And I know as you get
Mhm.
older, that's definitely even more valuable to spend time with your family. So the other thing I did want to touch base with you on is the anchor and buoy theory and how that strategy would be pretty good as we enter maybe some of these, as you mentioned, turbulent times where we don't really know what's ahead. Maybe you can give us a little bit of an explanation as to what that theory means and how to use it.
Good. It is interesting because when you do invest, I'm not a stockbroker or any in any way, shape, or form, but sometimes if you have a wealth advisor, they might be talking to you about having some money in stocks and some in bonds so that you have a balanced portfolio. And in real estate, we call it the anchor and buoy, which is similar because if you have a property like a FedEx distribution center or an Amazon or a CVS, Dollar General, whatever it might be, that triple net property that you might have heard of. We see that as very predictable income. Now, granted, one of those companies could go bankrupt and not pay the rent, which would be a problem, a big problem. You'd have an empty building just like you would if your tenant moved out across the street. But that gives you that anchor. So you know that, or you hope that that income would continue. The buoy, on the other hand, kind of can be a little bit up and down. You could have something like multifamily, and then there be a moratorium on evictions and rents dry up for a little while. Or it could be that a tenant moves out, or we get a big recession and then multifamily or self-storage, short-term industrial or short-term office, those rents could go up and down a little bit. But if we get inflation, maybe they go up over time to capture that inflation, just the organic growth of the rents. So on one hand, you have that predictable income. On the other hand, you have something that might go like this. And depending on your risk tolerance and your interests and your age, you might swing more in one direction than the other. And that's where we do something that's really interesting. It's so much fun, which sounds a little crazy, but if you were interested in looking at DSTs, even as a trial run, a lot of people will do a trial run. The minimums can be anywhere from 25,000 to 100,000, and you do a practice one. You pick the property you like. We walk through the PPM, which is the private placement moratorium. We actually design a portfolio or just one, and then you start seeing how it works. And you will be able to, if you have an exchange or you're interested in investing, then we keep track of what you already have and what maybe you want to add to your portfolio. If it's a 1031 exchange, it's going to be kind of very time sensitive because you have 45 days to choose your properties you want on your list. But with the DST draft of the sample portfolio, it's a really interesting way to put things down on paper and see if it might be a good fit for you.
I love that. That is great. And I think it really helps to put things in perspective as well and to see the options on paper.
Mhm.
Absolutely. Well, great. I'm really glad that you explained that. If you have any other final comments that you'd like to share before we let you go, I'd love to hear them.
Okay, good. The one thing that kind of is worrisome in the market of especially apartment complexes is that the the laws are changing in a lot of places to
Yeah.
reflect, gosh, in some cases, in some areas, you can't do criminal background checks, or you
Yeah.
can't look up financial background checks. And I think, oh my goodness, how could that happen? And you're not allowed to evict in some areas, which really makes it hard, or have, there'll be a limit on how much you can raise rents or how much you could keep as a security deposit. And so if you happen to be in one of those areas, the DST might give you that diversification so that all of your money
Mm.
might not be in that area. I know I wouldn't have wanted to be a New York City landlord of office buildings back at the beginning of COVID. That would have just been, oh, that concentration in one area is something that's a little nerve-wracking for me. And with the DST, you get to spread out. You don't just have your money in multifamily. You don't just have it in that area where there might be some more tenant-friendly properties. So the DST is just a really good option for not only the 1031 exchange, but also for cash investing. We have some funds that are debt-free. And I know I'm a bullish on debt-free, because if you were to look at a real estate investment trust that had a loan on it, or properties that have a loan on them, if that loan goes up in interest, it's going to come out of somewhere, and it's likely going to come out of the rents. So that's going to soften or hurt the returns on those. But if you're in the same kind of a fund, but there's no loan on it, and we have those available, it doesn't matter what the interest rate does, because you just maybe own an undivided interest in a portfolio of single tenant net lease properties like Dollar Generals and AutoZones, as I mentioned earlier, or pharmacies or convenience stores, or an undivided interest in apartment complex without debt. So again, just another interesting way to invest and use the syndicated real estate world to open up some possibilities, some solutions for investing or for 1031 exchange issues.
Absolutely. Well said. And I think, the other thing I really like about K Properties is the due diligence that you all do on those properties as well. You do a lot of the work for everyone there who's trying to, figure out what to do. You have pre-vetted properties that are ready to go for these DSTs. And I think really making it a good idea right now in our economy, especially working with a company like K Properties. That was an excellent explanation of everything. You say it so flawlessly. I'm always impressed.
I like it. The thing is, I like them, and I liked triple net properties, but I never bought one. I sold hundreds of millions of dollars in triple net properties where you don't have any responsibilities for taxes, maintenance, insurance. But I never bought one because I just could not bring myself to put $1 million or $1.5 million in cash down and borrow another $1 million at my age, right? And sign personally for a loan. So I never bought what I was selling. And then when I found DSTs, I thought, oh, I'll take one of these. I felt like Forrest Gump. I'll take one of these and I'll have some of this. And so it was a whole new world. And as you said, with K Properties doing the due diligence for you, the third-party reports are all right there. Before I can offer anybody a piece of one of these properties, the sponsor, the company, has to already own it. So they've done the third-party reports. They've done the survey, the title, the phase 1 environmental, the building condition report. All those are just there on a shelf. And when you're ready to choose, I mean, it's like going to the shelf and picking out the ones you like and how much you might want in each. And because we do the due diligence, you have access to seeing the pros and cons. There's no one property that is perfect. I can guarantee you that. And we don't guarantee anything, but I can guarantee you there's no property that's perfect. We can always find something wrong with it, but you have to weigh it. And does this fit or not in your decision making? But we do have all those properties available at our website, which is kpi1031.com. And our 800 number is 855-899-4597. So happy to get together and do a sample like what I called the sample portfolio, to put your ideas down on paper and then fiddle with it until it fits just right.
Yeah, can't hurt. So thank you so much for offering that, and also for all of your time today. This is really helpful. I'm excited to have you on the webinar later this month. I'm going to give it a quick plug. July 14th at 11 a.m. We're going to have Betty give us a full presentation with more details. So if you're still scratching your head and have more questions, Betty's going to go through it really detailed as well. So be sure to tune into that. And Betty, thank you so much again for your time. It's always a pleasure talking to you.
Thank you, Alexandra. It's been fun, and have a great holiday weekend.
You too. Take care. Bye.
Okay, bye.